I would like to invite the panelists for our next panel discussion session. So Sunil Benmadou, CEO of the Stock Exchange of Mauritius, Didier Vinay, and Mikhail Denenga. Please join me on the stage. So again, good afternoon, ladies and gentlemen. So we'll now proceed with our panel discussion on channeling capital through Mauritius with regards to real estate development in Africa. So we have with us three distinguished speakers. Sunil Benmadou, who is the CEO of the Stock Exchange of Mauritius. He's been around for 2 decades. Really, Sunil? 2 decades, right? Time flies so quickly. And we have Didier Vinay from Ditos, one of the leading offshore management companies. Didier is a senior manager, right? And we have Mikhail Denenga, who is a partner of Weber Wenzel, one of the leading law firms in South Africa. And Mikhail is a lawyer specializing in fund formation and structuring of investments across jurisdictions. So I'll start with the first question with, next to my left, with Sunil. So Sunil, you've been around for more than nearly 2 decades at the helm of the stock exchange in Mauritius. So you've seen a lot of things. You'll be at the sort of base, the foundation of internalizing to the stock exchange and bringing the stock exchange to the world, yeah? So, and bringing also the world to the stock exchange. Could you please tell us, as far as the success of the stock exchange in attracting the listing of a number of real estate companies on its platform, including those, of course, investing in Africa. Could you please tell us a bit about the key competitive factors underlying, of course, this sort of success?
Thank you, Shamin. Good afternoon, everybody. I think listening to the presentation of Bronwyn, I think she said a lot about Mauritius. She's been a fantastic ambassador of Mauritius, but also of the Stock Exchange of Mauritius. So to answer your question, I think I need just to give some background about the Stock Exchange of Mauritius and very quickly tell you the story about how we moved from what was historically an equity-centric domestic exchange to an internationalized multi-asset class exchange. So the Stock Exchange of Mauritius is a relatively young stock exchange with a history of about 29 years. And it was set up at a point in history where Mauritius, as an island, was going through a major structural transformation to move away from an agricultural-centric, sugarcane-centric economy to a diversified economy to leverage on some of the advantages that Mauritius presented. So in that context, it was felt by the then authorities that to accompany that transformational phase of the economy, we needed a modern financial services sector, and that's where, you know, a number of institutions in the financial services sector, including the stock exchange, was set up. But, of course, as most exchanges, when you're set up, you cater for your domestic economy, you cater for your domestic companies, and you cater for your domestic investors. So for the first 15 to 18 years of the exchange, we were essentially an equity-centric domestic exchange. Then, by the end of the 1990s, we realized that to grow the exchange, we had to leverage on the global positioning of Mauritius as a financial center. We had to leverage on what we call the global business sector in Mauritius, what it is all about. It's what, for example, people like Bronwyn have been doing. Mauritius is growingly being used as a structuring place from international investors to invest in different regions of the world, including India and Africa. And for your information, Mauritius has been the main investment arm for foreign investors going into India for the last 20 years. And now Mauritius is trying to become the premier service hub for Africa. So when at the exchange we realized that there was a golden opportunity for us to branch out of the domestic economy, internationalize our platform, and make the SAM not only an attractive listing, trading, and settlement platform for international companies, starting with those that are structured in Mauritius. We also realized that we wanted SAM and Mauritius to become a very attractive and compelling capital raising platform. So to go through that transformational phase, what we did is Shamin was the head of listing in those days. We went through a major overhaul of our listing framework to enable us to list a whole variety of products, a whole variety and types of companies. We then went one step further. We realized that if we want to be an international exchange, and if we wanted to attract international issuers like GRIT, for example, but there are many others, we had to differentiate ourselves from the rest of the exchanges operating on the continent, and that's where we went ahead and introduced the multi-currency capital raising, listing, trading, and settlement platform, which would allow an issuer that decides to use our exchange as a capital raising or listing platform to choose to raise money in dollars, in euros, in pounds, in South African rand, and then what else? In GBP, I said, and then in Mauritian rupee, of course. And the reason why we did that, it's because we realized that many of those companies that are structured in Mauritius as global business companies, they have clients that are sitting either in the US or in Europe. So if they wanted to tap from those investors, they needed to be given the opportunity to raise the money in the currency which would appeal to their investors. So we went ahead and did that, and that was a major transformational change. And since that, we've also introduced a number of other changes. So to cut a long story short, this has been a tremendous success for us. We started this whole journey about 10 years ago, and I can tell you that over the last 10 years, we've listed 183 new products, out of which more than 100 are non-Mauritian linked products, which means these are products issued by global business companies that are structured in Mauritius but doing business in India, in Africa, and elsewhere in the world. These are African issuers that have chosen to list on our market but are raising capital globally. These are international niche companies that are leveraging on Mauritius. And just 2 days ago, we listed a very innovative product, which is the first of its kind, promoted by the African Development Bank and also managed by one of the large commercial banks in Mauritius, MCB, which is an ETF which would allow international investors looking at having an exposure to sovereign debt from well-graded African countries to invest through an ETF and get access to the underlying sovereign debt instruments. We just listed that. It's listed in dollars, traded in dollars, and this is targeted to the international community that want to get the high yields that many of these government debts offer, but at the same time have a traded product in US dollars, which is liquid because it's an ETF and there is a guarantee market maker at the back. So to come back to your story, I think what makes us successful with regard to companies like GRIT, but to many others, not only involved in real estate, but also cutting across a wide spectrum of industries, is, first of all, a very flexible listing capital raising framework. For example, when GRIT, in fact, I want to use the example of GRIT because Bronwyn told the story. When she came to us 5 years ago and said, I want to list, had we not brought the changes to our listing framework, they wouldn't have been able to list. Why? Because they didn't have a track record. But we already understood that to attract some potentially good companies, we needed to make some changes to our listing framework, which would allow us to also list a company without a track record, but provided that they have a business plan that stands the test of our thorough scrutiny and that is credible and that they have the management experience. And we've done that with a number of companies, and they've done fantastically well. And it's a great story to see that a company that listed only 5 years ago has become, I think, in terms of market cap, number 4, and has even gone beyond Mauritius, has come to list in South Africa and recently listed in London. We had another company which came to Mauritius from a $100 million capital raising company, went through a number of capital raisings, listed in Johannesburg, became a 6 billion euro company, and now is trading in Europe on Euronext. So these are the kind of stories which tells us as an exchange that what we've been doing has been right, we have been innovative, and we are receiving the support of issuers. And I think that augurs well for the future.
Yeah, thank you, Sunil, for your very elaborative answer and reply. So you've talked about the stock exchange. Bronwyn has been talking about, on the other side, the companies who have come using the stock exchange. And you've talked about the global business sector. I would like to turn to Didier. So you work in the global business sector. And as we all know, the global business sector, which exists since in the early 1990s, has been facing a lot of challenges and threats, notwithstanding the fact that it has been quite resilient during all those years. But recently, in the budget speech by the Prime Minister and Minister of Finance, there are some measures that have been announced. And the question that I'd like to pose to you, maybe as a brief, you could just explain quite briefly the measures, the salient measures which have been brought about in the budget speech by the Minister of Finance. But afterwards, if you could if you talk a bit about what sort of impact have these measures had on your particular business and on the global business sector as a whole, and what are sort of mitigating factors that you're trying to bring into your business model in order to take these challenges away. Thank you, Didier.
Okay. Thanks, Ramin. I don't know if it's working. Yep. Okay. Well, yeah, there's been a lot of changes in the Finance Act, and what one could clearly see the invisible hand or the visible hand of the OECD in the directions given to the global business industry. So quite a few changes. The main one being the abolition of GBC2s, as from the end of 2018. We saw that coming as players, and we had already factored that in our advice to our clients, but it was just the formal announcement through the Finance Act. We've seen also the launching of a new category of legal structure, which they call authorized companies, and which is supposed to retain the attractiveness of GBC2s. Although the full mechanics of these authorized companies are yet to be made more clear. There's been some changes announced to the regime of GBC1, where the authorities are asking for more substance and expecting more depth and breadth of local business presence and activities in Mauritius. From a tax perspective, there's been a change to the deemed foreign tax credit, which is being replaced by a partial exemption scheme. And again, this is yet to be fully detailed by the fiscal authorities. And there's been some tax incentives removed from the freeport sector. So, I mean, some might concur with you that those changes could be seen as radical. But those who have followed the trends of the OECD, the tone set by the OECD for the last 4 or 5 years, with BEPS, with MLI frameworks, would have seen this coming from far, okay? In my mind, this radicality is less of an issue than the many loose ends that there are in these announcements. The practical applications of these new announcements is posing some issues, and we need the authorities to address these clarity and certainty issues soonest, because that would definitely push our clients to other jurisdictions. So now your question is very specific about our firm, DITOS. So let me share with you the strategy that we have crafted over the last 4 or 5 years, because we could see all this coming with the pressure on the Mauritius-India tax treaty. So we've been looking at that very closely. So it's been some time now that we've realized that we needed to extend the DITOS value proposition outside of Mauritius and extend that to the investee countries where our clients invest, and mostly in East Africa. So we decided to open regional offices in East Africa. We have opened Kampala in July 2016, and we have opened Nairobi in April 2018. So through DTOS Uganda and through DTOS Kenya, our clients are able to benefit from the same rigor, discipline, level of compliance, level of service that they would benefit through DTOS Mauritius. And we are extremely convinced that for us as a jurisdiction and as a player, to enhance substance in Mauritius, we will need to have boots on the ground in Africa and extend the offering of the Mauritian jurisdiction with a presence in Africa. That's the only way. And I can tell you that we are quite happy with the results. So what do we offer there? So DTOS Kenya and DTOS Uganda, we offer company formation. We would create local companies there in Uganda. We would administer these for our clients. We would ensure compliance to the Mauritian levels. We would offer admin support services like processing of payroll, filing of statutory returns, and setting up your fixed asset registers and all this. We would offer financial accounting support services, meaning keeping the books, having your dashboards, preparing your accounts according to IFRS standards. And we would eventually second skilled staff to our clients. We are quite happy that this business model, this new business model, has been tried and tested and fits perfectly well with what would be expected of a regional financial center aiming at being a purveyor of FDI into Africa. So we are planning to replicate that model and open regional offices in Tanzania and in Rwanda in 2019. And we are looking very closely at Ethiopia, which is opening up, and which is going to attract a lot of FDI very soon.
Thank you. Thank you, Didier. So you've talked about Mauritius, we've talked about Africa, we've talked about cross-border transactions, and etc. So now I would like to turn to Michael. So Michael, as a lawyer specializing in fund formation and structuring of investments across jurisdictions in Africa, I presume, so you would well be aware that there are some risks that affect all investments that cross borders. So with your background and experience in dealing with those funds and investment funds, so can you talk a bit about the risk mitigation policy at the level of those funds or initiator of those funds when they cross borders?
Thanks, Shamin. Good afternoon, everyone. First of all, I think a lot of the risks that are attendant on any investments in Africa have been canvassed quite a lot in previous panels this morning. A lot of that relating to currency risks. So is this on? Relating to currency risks, risks pertaining to development, delivery risk, and also legal and enforceability risk. So I'm not going to go into a lot of detail around the particular risks themselves. Suffice to say, when managers are structuring their funds, I think they do have to do a bit of jurisdictional or structural arbitrage in that the first question probably to ask is, first of all, are you going to structure your investment fund for investments in Africa locally, onshore structure, or is it going to be an offshore structure before we even start talking about what is the most favorable offshore jurisdiction? And one of the reasons why onshore structures have not been favored, I mean, if you look at the recent stats now for GPs that are investing in sub-Saharan Africa, 75% of them, at least the bigger GPs, have chosen offshore structures. And the main reason is the very risks that have been, spoken about earlier. And a way of trying to figure out a way of shifting that risk and mitigating it from the onshore structure to an offshore structure. And of course, there are other reasons, for example, fund managers choosing to have parallel structures in their onshore jurisdiction, as well as an offshore structure as well. So if you look at South Africa, the recent research has shown that out of all the onshore structures, South Africa is the most favored onshore structure by their local GPs. And part of the reason for that is that South Africa, out of all the jurisdictions we've spoken about, probably has the most international international-based legislation. I mean, the fact that South Africa is part of G20 and has made G20 commitments that has led to our recent our Financial Markets Act, that has led to our changes to our regulations in terms of hedge funds, private equity, and various other asset classes, means that international investors generally can easily identify with South Africa. And it means that from an enforceability perspective, a documentation and a legal documentation perspective, South Africa would ordinarily have structures that are documented in a way that investors identify. But if you look at offshore structures, it goes without saying that Mauritius is the most favored structure. And that, in a way, is really motivated by the risk mitigation solutions that investors and investment managers are looking for when they set up a structure. It ticks a lot of the boxes. So if you look at from a risk perspective, what are the main issues investors and managers are looking out for? First of all, tax efficiency is obviously important, but I would like to just echo what a lot of people have said and what Didier has said as well, that it's not just about tax efficiency, it's about tax transparency. And in fact, we are finding more and more that the DFIs and a lot of investors now are saying we're not even worried about the tax efficiency aspects of it. We are only concerned about whether that particular jurisdiction is whitelisted, whether there's going to be any perception whatsoever that it is not a jurisdiction that's being favored only for its tax benefits. So a lot has to go into showing that there's other benefits why you've chosen that particular jurisdiction other than tax efficiency. Limitation of liability we've spoken about, and also just generally having a universe of different structures that one can employ that you can give as an alternative to investors. So Mauritius offers the limited liability partnership structure, which came into play in 2011. That is an excellent structure because a lot of fund managers and investors are very familiar with the limited liability partnership, the uncommanded partnership or anonymous partnerships, as others would refer to it. There's also the general collective investment scheme structure and the protected sole company regime. So it gives you those alternatives to be able to ring fence and risk mitigate in different ways, depending on the type of investor that you're talking about. Obviously, a lot has been spoken about the recent changes, particularly around place of effective management issues, making sure that there's substance over form when you set up a structure in Mauritius. But I guess the biggest risk mitigator is to ensure that there is substance over form, right? But a lot of the fund managers that we've advised, that is not a problem for them at all because they had substance over form in any event. This is something that is being looked at more closely, but is not going to change the way that they've been doing business in any event. I think a lot of people are concerned about the additional administrative headaches from a KYC perspective. It's a bit more cumbersome, it's particularly around the new disclosure requirements that have been brought about. So that is problematic. It's administrative headache, but I don't think it's too much of a big issue considering what the new rules are trying to bring into place. What we've seen just more, other than just from a general fund structure perspective, perhaps if we look more closely from a different structure perspective in terms of actually raising capital from investors and ensuring that you're risk mitigated. I mean, we've seen in Africa generally raising capital from pension funds. There hasn't been as big an uptake as we would like. We've seen that in Nigeria. The bond yields are pretty attractive for most pension funds. So being a less risky alternative, they would rather stick to bonds as opposed to investing in alternative classes. We've seen that in Kenya and other jurisdictions that generally the uptake has been low. So from a structuring perspective, what we've seen is the possibility that a lot of managers here would have seen of establishing a feeder listed fund outside of the local jurisdiction that attracts a different type of investor that's got a different ticket size and that's able to bring additional capital to the table other than the pension fund or institutional investors. So for example, in the South African space, the alternative is to have a South African structure, but to also attract investors through a listed fund in Mauritius. And the beauty about that is if we're talking about all these place of effective management considerations, if it's a listed fund, its only decision is really to invest in an underlying fund. So from a decision-making perspective in Mauritius, it's a lot easier to show that all your decisions are being made out of Mauritius. The reputational risk issues are massive. I mean, we're talking about money laundering, corruption, dealing with politically exposed persons. I mean, first of all, I guess the big risk mitigator is don't deal with politically exposed persons, right? But from a documentation perspective, there's a lot that can be done. For example, in fund documents, in partnership agreements, making sure that it can become a cause event. In other words, an event for which the general partner or manager or the key persons can be removed if they associate themselves or in any way partner with politically exposed persons. And of course, obtaining all the necessary representations and warranties that that particular investment fund will not deal with politically exposed persons. The OEC guidelines are there in terms of how you deal with politically exposed persons and anti-money laundering, so those have to be adhered to, and generally just complying with the FATF recommendations on money laundering and KYC, not only at the fund level, but also ensuring that the portfolio companies as well are sticking to the international best standards when it comes to anti-corrupt and anti-money laundering activities. I won't talk about development risks for long, other than just to say that the best way to deal with those, particularly when one considers the lack of sometimes resources in particular jurisdictions or skilled and experienced personnel, is to find a way for managers to actually have a good link and see the whole construction link from beginning to end, either through their own experienced personnel or partnering with those that have that experience. And then the legal risk is a big one around enforcement. Enforcement is a big thing. It's been spoken about at ad nauseum today about how you enforce in particular jurisdictions. Nigeria, for example, very difficult to enforce. If a tenant is giving you problems, sometimes it's actually better not to go to court. It's better to find other ways of amicably dealing with it. So that's going to be a very difficult one. But try and contract out of that through your arbitration clauses, trying to make in the governance law outside of that local jurisdiction to ensure that you've got recourse outside of that local jurisdiction.
Michael, just we're running short of time. So you've talked about fiscal benefit, etc., so the fiscal advantage. So Didier, apart from the fiscal advantage, which many people tend to ascribe to Mauritius, which is not really true, in fact, as a matter of fact. So from your viewpoint and from experience in dealing with people, in dealing with entities, trying to incorporate structures in Mauritius, so apart from the fiscal incentive, which normally would apply, what other incentives, other benefits which would likely to accrue to people using Mauritius as a base, as a jurisdiction, in order to further their developments in Africa?
Well, I think there's the business ecosystem is quite proactive in Mauritius. There's more to it than just tax advantages. We can mention the IPPAs, we can mention the international accolades, we can mention the favorable time zone, we can mention the presence of international banks, access to private counsel as the Supreme Court of Appeal. We can mention the regulatory framework with the different laws, with the Securities Act, the PCC Act. I think what's more important is the commitment of the government to have the jurisdiction to be a jurisdiction of substance. It's very disruptive these days. It's very, very difficult. Even the regulator, FSC, is having a tough time to be able to make things happen. But I believe that it's the only way. We cannot not have a no compromise approach. And I think after we've gone through that steep learning curve, it's going to be very attractive doing business in Mauritius, because it's going to be a whitelisted jurisdiction of substance and reputable and respected. So tax should be the last element on the list.
Okay.
Yeah.
Thank you very much for your reassurance, Didier. So Sunil, I would like to ask you a series of questions. I would like one question, but different parts. You should just take it quite briefly.
Absolutely.
So for the benefit of the audience, I think it's good that they know how many, for example, how many real estate companies are currently listed on the stock exchange of Mauritius. What is the total market cap of those companies? How much capital have they raised since they have been, the board has been implemented at the level of the stock exchange? How many of these companies are investing throughout Africa? What is the market cap? How much capital have they raised since on the SEM? And also, finally, perhaps, so what sort of initiatives at the level of the SEM are you embarking on to attract foreign companies to raise capital, use Mauritius, raise capital to further their growth into Africa, and not only Africa, but elsewhere also?
Thank you, Shamin. In fact, before I answer this question very quickly, because as you mentioned, there's a time constraint, I just wanted to add to what Michael and Didier have said regarding using Mauritius not only for tax arbitrage opportunities. I think I met yesterday in a conference on the financial services sector in Mauritius a representative of one of the global firms that use Mauritius and who, you know, deal a lot with US investors. And I asked him this question, you know, what's really driving your clients to use Mauritius? And it was very clear. He said, of course, there are the fiscal arbitrage reasons, but he said that there's much more to that, especially with regard, because his clients invest through Mauritius into India. And his answer was very simple. He said that those US investors, and this also applies to South African investors and others that use Mauritius, they are looking at investing in in India because of the tremendous return potential that India as an economy represents. But the reason why they do that through Mauritius, it's because investing in India is very bureaucratic. They want to, you know, transfer that headache to those management companies that operate in Mauritius and just get the benefit of the returns that India offers. So I think that's a very important statement that he made that shows that fiscal arbitrage, of course, is an important decision maker in terms of where you're going to invest and whether you would use Mauritius. But there is much more that Mauritius offers as a jurisdiction because it facilitates the investments into those countries that are relatively bureaucratic and difficult. And I think the same notion applies to investing in Africa by using Mauritius. It's not only a question about Mauritius having signed double taxation treaties, which would then make your investment more tax efficient by using Mauritius, but I think it's also dealing with all the headaches that, you know, investing in different. So basically what we're doing is centralizing your investment decision through one jurisdiction, which is open, stable, which has a lot of advantages and which makes it very easy. So I think that's very important. Now coming back to your question, and on top of that, there is a stock exchange that makes your life even easier through capital raising and so on. Now, coming back to your question, as I mentioned, we have been internationalizing and we've been listing a number of products over the last few years. So how many of those are real estate focused? I was looking at the stats. There are about 18 companies that have listed, which are international, that have listed on the stock exchange of Mauritius that are investing in the real estate business globally, across Europe, across other jurisdictions, but also in Africa. Those that focus, some of them are focusing, you know, outside of Africa, but also in Africa. But those that have investments only in Africa, there are about 4 of them. And those 16 to 18 companies that have a real estate focus have raised about $2 billion in terms of for their investment opportunities since their listing in Mauritius. Those that invest solely in Africa, they have, I think, raised about $600 million, which is not little. And their total market cap, those 4 that invest solely in Africa, I think they have a total market cap now of about $900 million. But as I speak, you know, all these figures are changing because we are receiving more and more listing application. Just wanted to ask a question to, if you don't mind, Michael.
They just showed me that I have like 5 minutes just to wrap up. So if you can conclude.
Yeah,
with you,
quickly to Michael. You were talking about using, you know, creating feeder funds that would be able to raise money outside of Africa, outside of South Africa, because pension fund money is limited, and then list those funds which make the capital raising maybe potentially more attractive. So do you see that as a potential listing pipeline for the stock exchange of Mauritius?
It's definitely a potential for growth for the exchange in Mauritius, because we are seeing clients generally look for those alternative pipeline of investment, whether it's from Mauritius or any other exchange. And I think you're going to see a lot more inquiries over, in the coming months around that.
Thank you, Sunil, and Didier and Michael. So we have like 2-3 minutes left. I would just like to invite the floor to ask a few questions, but preference will be for ladies because we do not have any questions up to now from ladies. So the first lady to stand up and pose a question, please. First lady. So somebody, we do have somebody from GRIT here. Because one lady was asking a question with Bronwyn, which she happened to be quite, her voice was quite low. She wanted to know what's the significance of GRIT. What does the acronym GRIT mean? I know it's resilient. Kesavan? Okay.
Sorry. No, I'm saying that grit would be strength of character. That's what we want to display.
Okay, can we have a question, please? Yeah, okay.
Thank you for hello. Thank you for a fantastic panel. Thank you. It's quite informative. Dion Rouet from Forum Properties. We have a very large development in the Congo, which is we'll talk about it tomorrow. But what we've seen, the strategic importance of cobalt and lithium-ion batteries, and World Bank estimate the Congo's mineral wealth about $24 trillion. So we've seen a lot of deal flow coming from Hong Kong and from Dubai and also from other places. Mr. Sunil, do you guys see a lot more strategic importance between Mauritius and companies sitting in this environment, either mining companies or real estate companies? Or Didier, do you guys see any growth in that relationship between the two countries?
Yes, we've seen, depends from where. From Australia, we've seen Australians not using Mauritius at all because of the tax persecution in Australia. And very often the miners in Australia are listed at the very early stages of their exploration and exploitation. And anything which has to do with an offshore center might attract problems with the ATO. So other than that, yes, we've seen a lot of investors in the mining space using Mauritius to invest into these places. Definitely the flows are there. We've seen them. We've seen them. Yeah.
Okay, thank you. I think time is up, so that's a question. So we'll take a question from a lady. Yeah, sure. Thank you.
Sorry, it's not a question. It's just to give you a bit of, it's guts, resilience, innovation, and tenacity.
Thank you very
great.
much.
Okay.
This should have come from a lady, huh?
Sorry, can
Thank
I
you very
just
much.
say something very, very quickly?
Sure.
Just
Very
to wrap
quickly,
up.
very
Yeah.
quickly.
So just everyone is talking about the transparency issues and the new budget release, new changes and all of that. But what we've found is that even prior to those changes, there have been a lot of changes in the partnership agreements and fund documentation generally, requesting more transparency only because of Abraj. So it's already taking place outside of legislation. It's happening in documentation in any event.
Yeah, we had a very good presentation today, panel discussion on transparency. It was very informative. So you're adding to that. So thank you very much for your attention, ladies and gentlemen. Let us give a good round of applause to our distinguished panelists. Thank you again for your attention.